Hello everyone. This video is going to help you with your final homework problem 1423. So we are going to again prepare a master budget for a retail company with no beginning account balances. So we've got the Inwood Gifts Corporation beginning today on December 31st of year one. Rebecca Ortiz, the president, is trying to prepare the company's master budget for the first 3 months of year two. Since you're her good friend and an accounting student, she's asking you to prepare the budget based on the following specifications. All right, so we're going to round all of our computations to the nearest whole number, and we are going to start with creating and preparing a sales budget. So we estimate that January sales are going to be $500,000, of which 30% are cash and 70% are credit. So the first thing we have to do is figure out how much is cash and how much is credit. So 500,000 times 0.7 is going to be 350, and 500,000 times 0.3, or you could take 500,000 minus 350 and you get 150,000. So $150,000 are done with cash sales and 350,000 are done with credit. And then the company expects that our sales are going to increase at the rate of 10% per month. All right, so let's come down here. And we see that our cash sales again are already put in there. So we now need to figure out what are we going to have for February sales. So we know that our sales are going to be 150, 10% more times 0.1, which is 15,000. So when we add those up, we should end up with $165,000 in cash sales. And then we do the same thing for our sales on account. So we're going to take that 350 times 0.1, and we get 335,000. Add those together and we end up with 385,000. That's a 3. And then when we add those together, we get 550,000. And then repeat that process for March. So we're going to take that 165 times 0.1, which gives us 16,500. Add that to the 165, and we get 181,500. Same process for the 385,000. Take 385 times your 0.1, which is 38,500. Add that to the 385, and you end up with a total of 423,500. And when you add those two numbers together, you end up with 605,000. So that's our sales budget. Now we've got to look at part B, where they tell us that the company expects to collect 100% of the accounts receivable generated by the credit sales the month following the sale. So cash, we're obviously collecting in that month. So February, we're going to collect 165,000. March, we're going to collect the 181,000. But we're collecting the previous amount for accounts. So since there wasn't a December, we collect 0 in January. And then in February, we're going to collect that 350,000 for a total collection of 515,000. And then in March, we are going to collect February's 385,000. For a grand total of 566,000. Oh, sorry, 566,500. Now we've got to figure out what's going to go on our pro forma account, pro forma statements. So for part A, we're going to see what is on our accounts receivable at the end of the month. Well, we've paid off January and February, the highlights, so that means we have $423,500 left in our accounts receivable. We need to figure out our total sales revenue, so we have to add up all of our total budgeted sales. Which gives us 1,655,000. And then the last thing we need to look at is our total cash receipts for those 3 months. So for our statement of cash flows, how much cash did we bring in during those 3 months? So we add those three together. And we get 1,231,500. So that's parts A and B. We'll now quickly do parts C and D for your inventory purchases. So we come back up to part C and D and they tell us the cost of goods sold is 50% of your sales. So that's the first thing we need to figure out here, cost of goods sold. Well, if during January we sell 500,000, half of that is 250. So for February, if we sell 550,000, take that times 50% or 0.5, we find out that our February sales cost of goods sold are going to be 275,000. And then for March, half of 605,000 is going to be 302,500. So those are our costs of goods sold. Then what else do they tell us in part C? The company desires to maintain a minimum ending inventory equal to 20% of next month's costs of goods sold. All right. So if we look at next month's costs of goods sold for February, for January, we took 275 times, was it 20%? Yep, 20%, which gives us that 55,000. So for February, we need to take the 302,500. We'll just do that off to the side. Times 0.2. And that's going to give us 60,500. Now for March, we need to figure out what they think our sales are going to be in January. They just tell us ending inventory of March is expected to be 66,000. So we just have to put that in. All right, so if we have budgeted cost of goods sold at 275,000, we get 60,500 in ending inventory that we want. So we add those. And we end up with 335,500 in inventory needed. We subtract our beginning inventory, which is that 55,000 from the end of January. And when we subtract that, we end up with a total required purchases for the month of February of 280,500. So now we repeat that process for March. So we add the 302,500 plus your 66,000. So I'm just adding these two together. And we end up with 368,000 $500 worth of inventory needed. We start with what we ended February with, which is that 60,500. So if we started out with 60,500, we need 368,500. When we subtract that, we end up with total required purchases of $308,000. All right, so that's our inventory purchases budget. So then we look at Part D, and they tell us the company pays 60% of the accounts payable in the month of the purchase and the remaining 40% the following month. All right, and all of these purchases were made on an account. So the payment for the current month's purchases, what we do is we take that 305 times 0.6, and that's where we get that 185. So we're taking the required purchase times 0.6 to get this number. And then we're paying off 40% from the previous month, but there is no previous month. So that's 0. All right, so we look at, let's look at February. We've got 280,500. And we're taking 60% of that, which when we take that times 0.6, we end up with 168,300. And now we've got to figure out the rest of January. So we're going to take January's budget times 0.4. That gives us 122,000. So our total payments for the month of February is going to be 290,300. Then for the month of March, we need to take our March payment or purchases on account times 0.6. Which then gives me 184,800. And we have to add that to times 0.4 from February. So 280,500 times 0.4, because that's what's left. And that gives me 112,200. And when we add those together, we end up with $297,000 in cash payments that month. Then we've got to figure out our pro forma data. So what we first need to look at is on the income statement, we're going to need our total cost of goods sold. So we're going to have to add up all of those together. So 250 plus 275 plus 3025. That's going to give us a total cost of goods sold of $827,500. The next thing we need to figure out, what's our ending inventory on the balance sheet? Well, our desired ending inventory is what we desire to have at the end of March, which is just $66,000 worth. We're then looking for the ending accounts payable. So we've paid off 60% of that 308,000. So our ending accounts, we've already paid off the 305. We've paid off all of the 280. All we have left is the rest of that 308, which is 40% of that. So take it times 0.4. And we find that our ending accounts payable is 123,200. And then the last thing we need to figure out is, what is our total cash payments throughout the first 3 months for our statement of cash flows. So then we're just adding up that total budgeted payments. So 183 plus 290, 300 plus 297 gives me a grand total of 770, 300. And that's parts A, B, C, and D for this final problem, 1423